Welcome back to the show at 6:33. Talking a little bit about the distortion of capitalism. It's interesting. I was watching. I wrote this article Thursday and Friday, and a little bit on Saturday, and then on Sunday, I'm sitting around the house, and there's nothing on television
worth watching.
Worth watching.
There's lots on. It's just junk.
I know. Then, so my wife and I watched the Texans play.
Yeah.
So that just became a blowout. So
it was actually encouraging.
It was. It was very good. It was a great game. But after that, Dallas came on, so there was no sense in watching that. So I started flipping channels.
Yeah, click.
I started flipping channels, and I ran across this movie called The Company Men. Did you seen this movie?
I've seen it, yes.
Okay, so it stars Ben Affleck, Tommy Lee Jones. There's a bunch of big actors in it. And it was interesting because I'd written this article about capitalism, and so I started watching this movie called The Company Men, and it's about this big company. And they start downsizing because they're, running into financial issues, share prices falling. So the C-suite executives, the big executives in the company, they're, kind of going out. They're buying an office building and they're renovating an entire floor of this high-rise building for just 5 guys that are, the top of the ladder, so to speak. But yet they're laying off all these people, right? All the workers, all the people that built the company. They're laying those guys off, cutting salaries, doing cutbacks, but the executives, they're kind of gorging on, the coffers, and which is really kind of, you watch this movie and it's very much the idea of what's happening in the economy today, and this kind of anger we have towards the billionaires, right? The ultra rich, and where do most of these ultra rich reside? Well, those are mostly in the companies that people work for, the Apples, the Googles, the GMs, the Fords, these type of things. The head of the FedEx is an example. Fred Smith, the guy that owns FedEx, he's worth about $4 billion. So we should go take his money away because he built this company called Federal Express that everybody uses every day to ship goods all across the country. So let's go take his money away because he doesn't deserve to have that much money. Even though this is a guy, as an example, that took his money, invested it into his company. Nobody believed in the idea of FedEx to start with, right? This was a thesis he put together while I think he was at Yale.
Got a C on it.
You got a C on it,
yeah.
Right? Yeah. Nobody liked the idea. So he goes and takes his own money and starts this company. And so he took a huge risk in an idea that nobody believed in to build this company. He's now worth like $4 billion. So he doesn't deserve that, right? Because he's now built this company in America that allowed him to build a tremendous amount of wealth. Well, this is the idea for Bernie Sanders anyway. Billionaires don't deserve to exist. So we should take all their money. But this is, part of the problem, though, is not the Fred Smiths of the world. That's not really the problem. They're a representation of a problem that actually began under Bill Clinton. In 1998, Bill Clinton wanted to put a cap on CEO pay. He says, CEOs are making way too much money to run the company. And I'm sorry, I said 1998. It was 1993. I apologize. So he passed this law that basically restricted corporations to expensing only $1 million of CEO compensation. So everything over $1 million could not be expensed by the company. Payroll expenses are deductible for companies. It's a tax that's deducted off their income. So they said, okay, you can pay your CEO anything you want, right? Brent's the CEO of Brent Enterprises. They have $1 billion a year in revenue. And Brent wants to pay himself $10 million a year. Well, under Bill Clinton's plan, the first $1 million of that would be expensable. The next $9 million, he'd pay tax. It would not be expensable by the corporation. The corporation would have to pay tax on that. And so the goal of that was to encourage corporations to rein in that pay, right? Corporations don't want to, not be able to expense off that money, so they cut the CEO pays back. It sounded great in theory. And this is the idea I was talking about a second ago, this idea we're going to wipe out $1.5 trillion in student loan debt and it's just going to immediately go into the economy. No, it's not. There's what's called unintended consequences of actions. The unintended consequence of Bill Clinton's law that basically limited CEO pay is that corporations, being very smart individuals that, look, if you're smart enough, by the way, to build, if you're Fred Smith and you're smart enough to build Federal Express, you're probably smart enough to figure out a way around tax law changes. Right? I mean, these guys are not dummies. So as soon as Bill Clinton says, well, we'll just cap CEO pay, the first $1 million, you're capped there. That'll fix that problem. CEO said, no problem. I'll pay myself $1 million in cash, and I'll take an extra $25 million in stock options. Those weren't under the part of the compensation package, right? So all of a sudden, we began this process beginning in 1993. And if you take a look at corporate profits as a relation of profits per employee, you can actually see in 1993 where this acceleration began. And I've got a chart of this in the article, so if you want to take a look at the chart, just simply go by the website, realinvestmentadvice.com, click on the article for today. But this is where this acceleration and this wealth gap began, because now all of a sudden, all these CEOs and highly paid C-suite executives are being compensated by stock rather than actual cash, right? So stock option compensation becomes a very big part of CEOs. Well, in order to convert those stock options into wealth, two things have to happen. One, your stock price has to go up. The second thing is you need a way and a method to convert those options back into cash. Got to have somebody to sell them to. Enter stock buyback programs. So we have an issue today where CEOs of corporations, people who have worked themselves into these positions, are taking home millions and millions and millions of dollars every year in compensation. So we're angry at them because it's just simply that they have way too much money and capitalism's broken and they need to share it with everybody else. Look, I get it, right? I'm not arguing that point. CEO pay is extremely distorted. The average CEO right now makes about 50 times the average production worker. But who are we angry at here, right? Are we angry at capitalism? Right? Do we need to ditch capitalism? Because, you know, a lot of your neighbors are independent business owners. You know, Mike Jones, he went and started an auto repair shop down the street and he fixes your car. My neighbor and my old neighbor owned an auto check here in town. Him and his wife, they bought an auto check, started up the business, doing very well for themselves, right? Capitalism. Susie Smith, she opened up a little, you know, she really enjoys yoga and fitness training. So she opened up a little fitness studio down the street from her house, participating in the American dream, right? Capitalism. What these two people have in common are the same thing, is that they both took a risk. They put their hard-earned life savings into their business in the hopes that they will be successful and they will be able to generate more income by selling their goods, products, or services to other people, you, and make more money doing that than working for somebody else. And they can build wealth. We're not angry at them, right? We're not after them to take away their money. We're not after the restaurateurs, the nail salons, the 80% of businesses in this country that make up all the businesses that we have, right? We're angry really at just one group of people, and this is the big major corporations, the ones that benefit the most from stock buybacks and kind of the distortion that's been created by Wall Street, right? We read the articles, you know, Adam, we talked about last week, Adam Newman, right?
You can use. Sign up for the Real Investment Report now
at
realinvestmentadvice.com.
Hundreds of millions of dollars with WeWork, and it's a complete sham, right? So that's who we're angry at, right? That shouldn't happen, but that's a distortion of what happens when you keep interest rates at zero rates for a decade, when you flood the system with liquidity, when you change rules and laws to benefit major corporations, right? We bailed out GM, we bailed out the banks, we bailed out AIG, we bailed out all these companies, and then we sit around and we're upset because now they have all the money. Because you didn't allow the system to work to begin with. The financial crisis would have solved your problem of this wealth gap CEO pay distortion thing if you had allowed the recession to actually work and do its job. But we bailed out all these companies, and now we're upset about the distortions. The point here, though, is simply this. Before we go kill the golden goose, which is capitalism, which allows America to have a higher standard of living than any other country in the world, let's focus on the problem. You know, the Obama administration wanted to fix healthcare. So instead of fixing what was broken with healthcare, they tried to reform the whole situation, made it worse. So before we go kill capitalism, let's just fix what's broken. What Americans want is a fair playing field. What Americans want is the ability for companies to represent them, right? If Americans want, this is a quote from William Lazonick from the Harvard Business Review, and he's absolutely right about this. If Americans want an economy in which corporate profits result in shared prosperity, that's what we want, right? We want corporate profits, shared prosperity. We don't want socialism. We want capitalism. He says the buyback and executive compensation visions have to end. But with any addiction, the withdrawal pains will have consequences. He's right. Be right back after the break.